Liebe Zuschauer, herzlich willkommen vom Parkett der New York Stock Exchange. Ich bin Manuel Koch und bei mir ist heute Peter Cardillo. Er ist der Chefanalyst von Rockwell Global Capital. Thank you so much for joining us, Peter.
Good to be back.
Peter, we saw a crazy week last week. It was an all-time high, 15,500 points, and all of a sudden Ben Bernanke came on camera, and then we saw a pullback. Is this the start everyone expected for a pullback?
No, I don't think so. I think we're in the midst of a mild pullback, and I think it's going to be short-lived. Let's just talk a little bit about Mr. Bernanke. What did he really say? He didn't say anything new. I think what really spooked the market, obviously, was the Fed minutes, where we saw a growing number of Fed members that were considering to taper off the QE. But in effect, Mr. Bernanke repeated himself, as he has been, saying that it's data dependent, and until we see some real evidence in terms of a decline in unemployment and consumer spending picking up, or even a reversal in inflation, that it's not likely the Fed is going to trim QE. So I think, the market needed to pull back. It was looking for an excuse, and the perfect excuse was the FOMC minutes.
Is this but just a little example how the market would react when the Fed really would decide to reduce or to stop the QE program?
Well, there's no question that when they do, they're going to have to do it very carefully, and the fact that there is a exit strategy plan already in place is not a bad idea. That's a good idea. They're going to have to maneuver it. But I think, one of the amazing things of the market is that the Federal Reserve and the market seems to always telegraph what may or may not happen. So when reality does set in, if it's done properly, it's probably not going to have a major downward effect, as some people fear. If, of course, you would get a sudden announcement that they were going to do it, and you would see a chaotic situation occur in the bond market, then obviously it would be very negative. But I think if you prepare the markets and, when the time does come, obviously that would be a good indication, because that would mean that the economy is no longer dependent on stimulants, and so that it can stand on its own 2 feet. That's not a negative, that's a plus.
Do you think we will see this happen already this year?
I think that we'll probably see them taper off perhaps at the beginning of the new year. So my guess is that they stay firm, because I think that the economic conditions are still rather soft. In fact, this week we will be getting Q1 final revision. We'll probably see that flat around 2.5%. But this quarter, we're probably seeing growth under 2%. So with growth under 2%, with Japan continuing to desperately inflate, and with Europe still in recession, I think there are still enough headwinds out there that suggest the Fed is going to continue at least for the next 6 months.
What else do you see at the moment? What's driving the markets?
What's driving the markets? What has been for the past several years. Cheap money, no place to put your money.
So how should investors at home react at the moment? It's you never know. Is the market going back? Is it going higher? The last weeks, everyone always said sell in May and go away, but this is not true, at least in this month anymore. So what would you maybe suggest, recommend?
I suggest that long-term investors stay the course, and if we do get a pullback that might be a little bit more than a mild pullback, then I would buy, because interest rates are very low. They're not going to go higher for a while. And just because the Fed, even if the Fed would curtail their bond buying program or stop QE, that doesn't mean that interest rates are going to zoom. So you can still get good returns in the stock market. And basically that's what this bull market has been all about. People seeking higher returns than you can get in the Treasury market.
What do you assume? How fast can we see this pullback of maybe 5 to 10%?
Oh, I don't see that happening. I think worst case scenario, maybe 3%.
So when we look to this week, you already mentioned the GDP. Anything else you are looking to?
Sure. We have a lot of economic data this week. We have housing. We have consumer sentiment, consumers' confidence. As I said before, the revision, the GDP, and we have some real key numbers: personal income, personal spending, and of course, I think that we're looking at numbers that will suggest modest economic growth.
In the end of the week, do you see as the markets higher or lower?
I think we're probably going to this week trade flat, build a base from last week's nervous market, and then probably move into June with new records.
Peter Cardillo, thank you so much for joining us today. Peter Cardillo von Rockwell Global Capital war das und Ihnen, liebe Zuschauer, vielen Dank fürs Zuschauen. Wir sehen uns bald wieder hier vom Parkett der New York Stock Exchange.